In this video, I will go over some examples of business transactions, which are business activities that occurs in the company, so-called economic events or condition that directly changes the entity's financial condition or its results of operations. Basically, a transaction is one where it impacts the elements of the accounting equation: assets, liabilities, and owner's equity. The core of this chapter is understanding these business transactions, how they are recorded. Accounting is the language of business, and in this language, transactions are used to communicate. First is to record them and then assemble the financial statements from these transactions in order to communicate to the users of accounting information. In this example, the owner, Chris Clark, puts money, $25,000 from his bank account into the business, Net Solutions. So the asset of the company, cash, is increased by $25,000, and the owner's equity is also increased by $25,000. What is the account that's being recorded? It's called capital, and capital is a type of owner's equity account. Capital has the impact of increasing owner's equity or ownership by $25,000 in this case, and cash is also increased by $25,000 because money has been injected as funding into the business. The increase of the asset, the account cash, by $25,000 is equal to the increase of owner's equity recorded under the capital account, $25,000. The accounting equation balances. The business has started and has funds to use. In this next transaction, it decides to invest in the purchase of land by using cash, $20,000, as payment for a future building site. To record this transaction, cash is decreased by $20,000, land is increased by $20,000, right? Because land, the asset, is now increased by 20. Cash, an asset, is decreased by using it to purchase land. Therefore, under assets, the impact is zero. But within assets, there are two accounts, cash and land. One increased $20,000 and the other decreased by $20,000. These two accounts offset each other. The impact to assets is zero for this transaction. Assets is still $25,000 and owner's equity is still $25,000. The accounting equation balances. To operate the business, the company needs supplies. So on November 10th, it purchased supplies for $1,350 and agreed to pay the supplier in the near future, meaning that it's not paying cash now, but it will pay in the future. So how do we record that? Let's do what we know first. Supplies, we know, was purchased, and so an increase of supplies, and we recorded using the supplies account, and supplies is asset. So record supplies increased $1,350. What would be the other account? We always need to record to two or more accounts to follow the double entry accounting system. The other account we know is not cash, because cash is not being used to pay for supplies. Cash will be used to pay for supplies, but that's in the future. Right now, in this period, in this month of November, we need to record the obligation to pay in the future. And we call this obligation accounts payable. We record the increase in accounts payable, again, an obligation. We have a liability. Accounts payable is under liabilities, and it's increased by $1,350. So in the accounting equation, assets on the left-hand side, $1,350 is increased. Liabilities on the right-hand side of the equation is increased by $13.50. Recording the balance to these two accounts will keep the transaction balanced in the accounting equation, and the accounting equation in total assets equals liabilities plus owner's equity remains to be in balance. Total assets $26,350, total liabilities plus owner's equity $26,350. What we just learned was that supplies was purchased on account, and we recorded to accounts payable a liability. It creates an obligation to pay in the future. Accounts payable are amounts owed, amounts due to vendors or suppliers for goods or services received. In this case, supplies was received that have not yet been paid for. Keep in mind that supplies is considered to be a prepaid expense account. Even though there's the word expense, it's not an expense account. It's a prepaid expense, which means it's an asset account. The asset becomes an expense as they expire, as they get used up or consumed, then it becomes an expense. So right now, there are $13.50 as the balance of the supplies asset. Some of that, or if not all of that, will be used up and the balance will be transferred to an expense. We will learn more about that at a later point.